Hello, fellow Rebel Capitalists. Hope you are well. I am here with my good buddy, Keith Weiner, and I haven't had the chance to really interview him in the past, so I'm really looking forward to this conversation. We've met a couple times at conferences where we've both been speaking, and out of everybody in the gold space, I think Keith and I share the most similar views. I don't know. I'm trying to think of someone else in the gold space who I agree with more, but honestly, Keith, I don't think there is anyone. So first and foremost, thanks a lot for coming on the show. We're going to be talking about a collaboration that you and I are doing later on in the interview. So super excited for the conversation.
Thanks for having me, George.
All right. First and foremost, what is going on with gold and tariffs? Because we've got the Bank of England, they're drawing down their gold reserves. All of that is coming to New York. And I just listened to a recent interview you did where you explained this really well, because you go on Twitter and you go on to, kind of the other financial podcasts, and you hear all these crazy stories. Some of them may be true, some of them probably not true, but you really dissected it and broke it down in a way that made a lot of sense to me.
So, the classic carry trade in gold, that's what it is market makers and trading houses buy spot and sell forward or futures because there's a spread.
Yeah.
And people mistake, they see the short position in the futures market and they think these people are betting the price is going to go down. No. They're just long gold somewhere else, which isn't visible, right? COMEX only shows they're short a future. They're long a bar in some other vault, which may or may not be a COMEX registered vault or even a London registered vault. And they're making a spread. And when that spread gets wider, then more of them jump in. When the spread compresses, some of them get bored, have better opportunities with their capital and move out. So I've been writing about that. That's called the gold basis for, 15 years or something like that. And, changes in that indicate changes in supply and demand in the markets. Let anybody who's looking at it, we publish these graphs for free on our website, by the way, daily updated. Anybody looking at it can kind of sense whether, a price move is real or whether it's just leveraged speculators, front running themselves. And all during the long, we'll call it the dark years, 2012 through 2018, every time the price would blip, all the usual suspects came out and said, price is going to go to the moon. And I was like, it's not, it just isn't. And they hated me, but I was right more times than I can, count on that, but it was easy. You're just looking at the data and you could see it. So there is a nice wide carry, spread or basis spread. And so people are putting this trade on. All of a sudden, Trump's talking about tariffs and nobody knows, which countries may be slapped with it, let alone which commodities.
Right.
Could that impact gold? So if there were to be a 25% tariff on gold, that's on the order of $750 an ounce. So imagine you are long spot, which is generally London, short futures, which is New York. And in order to deliver, you actually have to import gold. You did this trade to make $20, and now you're going to lose $750 an ounce doing this in size. So every one of these traders said, well, we like the trade because the spread is nice and wide. We have to de-risk it by moving the bars from London to New York, also Singapore to New York, also Dubai, anywhere where there's a good delivery refiner, let's get bars and bring them to New York. And so that's the trade. Everybody's talking about it. You had weird things with the exchange of physical spread, blew out. People talking about long delays in the Bank of England vault. Now, to put this in perspective, the last time I saw data, 3 or 4 weeks ago, it's a very small percentage of total gold in London. However, I don't know if you've visited any vaults. I've visited a number of them. They usually vary, they're storied and everybody talks about it and stuff. And of course, there's billions of dollars of gold there. But it's actually a very prosaic place. It's underground. It's a concrete warehouse with pallets or racks or something like that. And not very many employees, running around. Obviously, you have high-tech cameras, you have, vault doors and things like that. But there's not a lot of resources down there. And if all of a sudden everybody and their uncle is trying to get bars to move to New York, it's inelastic capacity, right? So they can't get the bars out fast enough, and everyone's at shortage, and the Bank of England is defaulting. Come on. People are trying to move the gold to get it into the U.S. before this tariff thing, should there be one, I don't personally expect there to be a tariff on gold, especially, probably not silver either. But on the other hand, I don't have, $100 million in that trade that could get, a 25% loss on it either. So that's what's going on. People are making up all sorts of stuff. The U.S. is repatriating its gold. The U.S. doesn't have any gold. They're anticipating an audit, so they're going to go buy all the gold and bring it in. It's just the carry traders de-risking their carry is all it is.
Yeah, see, that makes a lot of sense to me. And it's not, just to reiterate for the viewer, it's not necessarily that the Bank of England doesn't have the gold, therefore they're scrambling around trying to get it because they sold it to someone else and they've got to buy it because now they have to deliver. It's more so you've got this massive, massive vault in all these bars, and you basically have one guy there, and Joe has to go over there and pull the bars off the shelf. And he's like, I've only got 8 hours a day here. I can only pull so many bars off the shelf at one time. And that's more likely the explanation as to what's going on.
Yeah, usually, there'd be more than one guy, there'd be a couple guys, but, everything has to be done in pairs. People can't get into the vault with, one key access. It's dual.
Okay.
And so you have two guys that are actually moving it, and then there'd be two other guys in a control room monitoring it, two other guys signing off on it. There's a lot of controls around gold bars, as you can imagine. But collectively, that group of 6 or 8 or whatever it is has the bandwidth to do one move per 10 minutes. I don't know how long it takes. I mean,
right.
Because there's double signatures, everyone's double counting and double signing, and you don't want to make any mistakes. A 400-ounce bar is well over $1 million, so you can't have mistakes on this. So they make sure that they're not making mistakes. And it's labor intensive. It takes time. Only so many in the day. It's probably an 8-hour shift, right? It's probably either government employees or union or both. They're not working 16 hours just because the markets are going bananas. They don't care. They go home and have dinner with their wife and see their kids, and that's it.
Yeah. And man, if I'm one of those traders, I am, to say stressed is the biggest understatement of the year. I mean, think about that. You need that physical gold before there is potentially a 25. In other words, before you're completely wiped out. That's the bottom.
Yeah, that would be a extinction event. And
yeah, even if go ahead.
Within recent memory was COVID, and the same trade blew up because you're long metal in London, you're short in New York, and all of a sudden lockdown. There's no planes flying anymore.
Right.
This stuff normally flies around on the belly of commercial aircraft. Brinks doesn't have their own planes with it. There's not that much gold moving around. They stick it in the belly of United or American or whatever. Suddenly there's no planes flying. You can't get the gold over there, and your contract in New York doesn't care. You could declare force majeure and there's whatever consequences of that, but they don't care. I've got gold, it's just in London. If you have to deliver it in New York, you have to deliver it in New York. And then you couldn't, the other thing is there's a disparity in the size of the bar. In London, 400-ounce bars, New York is 100, or they'll do 3 kilo bars for a 100-ounce contract, which means it's London to Zurich or Geneva to, as refiners to refine it. Take the 400-ounce bar and refine it into 4 100-ounce bars or 12 kilo bars, and then ship that to New York. And if you don't have planes or planes aren't flying, then you can't do it. And so they've all been clobbered with that. And, all the risk officers of all these companies are like, we're not doing that again. All of a sudden tariffs and, this is what happened.
Yeah. So there's a lot of logistical issues there that I never thought of. Just even in the discrepancy between the size of the bars. If you're that guy in New York, even if you have the gold, even if it's in your physical possession, you have to break it down to a size that where you can actually deliver it and deliver what you promised.
And on the day.
Yeah.
Same thing happens. We lease gold, and we can talk about that later, but we lease gold to jewelers and all kinds of other people. And, before monetary metals, what they're doing is they're borrowing from the bank. Let's say they borrow $1 million. They buy $1 million worth of rings and necklaces and whatever. And then if the price of gold were to drop 10%, they'd have a $900,000 asset, but still $1 million liability. They're insolvent.
Right.
So what they do is I love the word just. They just hedge. Which means that, okay, you borrow $1.25 million, you stick $250,000 in a brokerage account, short gold futures. What do you do if the gold price goes up? You say, well, I'm hedged. I don't worry about that. Okay, you have jewelry inventory, which is slow moving. You have the futures market, which can be moving very fast. You have a margin call from your broker. You have all this gold over here. In theory, you're matched, but in practice, the logistics don't really, don't really work out in your favor. First of all, you don't want to sell all that inventory and close your store. I mean, that store is very expensive. You're paying a lot of rent, and you put a lot of money into halogen lights and glass display cases and whatever, and not to mention employees. And secondly, you can't liquidate it that fast anyway. So, they get clobbered when, let's say there's a margin call or whatever. And, these are the risks of playing, in the futures market.
Yeah. So this is what's going on behind the scenes, which I think it explains things that we're seeing in the mainstream media very well. Let's just assume for a moment we do get a tariff on gold and silver, although the probability is extremely low. What does that do? Because, I'm trying to think that through, and it's like, okay, now I've got this stockpile full of gold. Let's say you're an individual investor that is worth X, but now, is it worth X plus 25%? Or
very good question. So, obviously, if you can stockpile the day before the tariff and then unload it the day after, right? I mean, you might get a 25% boost in the value. But if you look at countries that have tariffs, let's say on gold, and I'm very familiar with India and Vietnam, the price inside the country can bang around like a pinball between world gold price and world gold price, whatever the tariff rate is. Now in India, they keep changing the tariff rates as well, which makes it even worse. And so, if let's say the tariff is 25%, $750, you can have a $750 volatility within the country, depending on whether the internal demand has to pull more gold in, or whether internal demand has subsided and internal supply is sufficient to cover the market. So that kind of volatility doesn't serve anybody except for a few traders that are nimble enough and smart enough to capitalize on, or have good information as to the, sort of changing dynamics of supply and demand. Everyone else gets clobbered. So if that happens, number one, you can't have a futures market in a country that has that kind of tariff. So you either destroy the COMEX or they have to move offshore.
Right.
So that would be very disruptive to them. A lot of people would say, well, the COMEX is the CRIMEX, let it be destroyed, whatever. But that's where, for good or for ill, that's where everybody hedges. You go to that coin shop and you want to buy that coin, and you see the gold price is $2,900, and you expect them to charge you $50 as a premium or $75 as a premium. That's because he's hedging the price risk. If you make it impossible for him to hedge, or it won't be impossible, it'll just be more expensive. You're going to hedge in some other market at some higher cost. Then you have to pass that cost through. So what you're going to find as a retail customer is that when you buy, instead of paying spot plus 75, you're paying spot plus 150. And when you sell it back, instead of selling it back for spot, it's now spot minus 75.
Right.
So you can have wider spreads, which means you need a bigger price move for when you buy in to when you sell out in order to come out even. So, the retail customer is going to get creamed. Anybody trying to hedge is going to get creamed. In a way, it'll be good for domestic U.S. refiners, because there's going to be demand for first of all, there's domestic gold produced anyway in the U.S., quite a lot of it. So there'll be demand for that, but on the other hand, it'll be harder for them to hedge. It just makes, the market more frictional, more chaotic, less coordinated. And, India, I don't know if you ever visited, India is an extremely chaotic place. It's amazing that any business can get done there. And
another thing I'm thinking, Keith, is if I'm just a gold buyer that buys it because there's no counterparty risk, that's one thing. But if I'm a buyer that buys it to speculate, if there's a 25% tariff, I don't know if I pull the trigger on that, because you don't know if Trump's going to come out the very next day and say, okay, I changed my mind, no more tariff.
Right.
And then you pay the X plus 25%, but now you can only sell for X. So are you really going to pull the trigger on that? I mean, that's a huge unknown as well.
Right. So then somebody's going to create a New York Stock Exchange listed vehicle where the gold is stored offshore, and then you won't be subject to the tariffs. Presumably, you're buying a security. The security wouldn't have the tariffs on it. The gold is stored offshore, so you're not importing it. So it just forces things to move offshore. And if the goal of all these tariffs is to help American businesses, all you're doing is hurting.
Right.
Nobody really wins in this, again, other than a few speculators that are, have enough insider knowledge to know when the demand is going to flip around, and there's a 25% spread to play with if you're good.
Yeah.
But
And I think when I was listening to your other podcast, you made a good point on the probability of that happening. And you said it's extremely low because just think of a nationalist argument for cars being made in the United States, but you don't really have that same type of argument for gold and silver. So other than just Trump doing it because he feels like it, or maybe it's a negotiating tactic, I don't know how that would be a negotiating tactic, but it doesn't have the argument for a tariff to build more cars at Ford or Chevy instead of
it's not a consumer good. And the other thing people don't realize, the margins in gold refining are paper thin.
Yeah, right.
So if you want to get factories in the U.S. to make semiconductor chips, those have big margins. You want to get factories in the U.S. to make big full-size pickup trucks, those have decent margins. You want to get more refiners in the U.S. to refine gold. I mean, they're working for less than 1%, per turn, and it's very capital intensive. So it's not a particularly good business anyway. And it's not. I mean, a lot of governments around the world try to incentivize domestic, like India. So to import gold into India, if you're importing finished bullion, there's a tax rate of X, which, these things move around. But to import doré, which is the unfinished gold that comes from a mine, it's X minus 0.75 percentage point. And so they're giving their local refiners 0.75 percentage point incentive, which is enough that everybody wants to import doré into India and not finished bullion if they can do it. So that gives you an idea of sort of the size of the margin that the refiners are working on.
Yeah, not much at all. So let's switch the discussion over. I want to come back to the gold price a little bit later, but let's switch the discussion to macro stuff, not just global, but maybe more so in the United States. I know you've got a much different view on interest rates, as an example, than most people in the gold space. So, and this is, I think, where you and I are pretty aligned. So can you tell me what your view is or what your base case is for interest rates for 2025 and why?
So I'll just start by noting interest rates have really been coming down this last couple of weeks.
Yeah, you're to the long end of the curve, right?
Yeah, right in the 10-year.
Yeah, and the 2-year, I guess, and the 2-year.
Yeah. So, my starting premise is radical and controversial, but I don't think it should be. And I think, going back to 1933, Roosevelt changed, that's when he made it illegal for Americans to own gold, basically pulled gold out of the monetary system. It was a felony to possess gold. It was like, if you got caught with a funny white powder today, go to prison if they caught you with it.
Right.
And, people say, well, he was grabbing the gold. It was a loot grab. Yeah, okay, I'm sure that pleased him no end. But the real purpose of it was to force the most conservative savers out of gold and into government paper. So by basically banish money, gold being money, out of the monetary system, and then everyone has to be some sort of creditor to either the Fed or the Treasury or the bank. And then if you're the creditor to the bank, they're just on lending to the Treasury or the Fed anyway. So you can't opt out of the system. There's no way for there to be a general sell-off of Treasury bonds. To hold the money balance is to hold government debt. You're financing it directly if you buy Treasury bonds, which you can do with treasurydirect.com. Obviously, the government promotes this very heavily. Or if you hold paper cash, those say Federal Reserve notes on them.
Right.
And a note is a credit instrument. The Fed issues this credit, like any bank would have done back in the day, in order to raise capital to buy its favorite asset, which is Treasury bonds. So if you're holding paper cash, you're actually financing Treasury bonds. You're letting the Fed keep the interest rate, and you holding the paper get nothing. Or you deposit in the bank, and what does the bank do? Well, they buy Treasury bonds by regulation and by business model. So you can't opt out. There is no such thing as a bond vigilante. There is no such thing as a general sell-off. Yeah, you get speculators moving things all around. You get gyrations. And I think that what people need to look at more is where's the demand for credit, other than the government, which has it relentless. But the government's demand is also its supply, because every dollar they borrow, they turn around and spend, and everything they spend goes back into the banking system, and then it's by seeking a home in the Treasury bond. So it's very self-referential. And so you can't analyze interest rates by saying, well, there's going to be more deficits, therefore rates are going to go up. we had more deficit rising probably every year from 1981 through when Powell hiked rates in 2022. And, always, the interest rate was falling during that period.
Right.
So I think what you have to look at is where's the marginal demand for credit? And, in the business world, in the corporate world, that marginal demand is whenever there's a downtick in interest rates, not when it goes up. And the reason is pretty simple, although counterintuitive. Every time the rate fell, which it was doing for 40 years, that's a fresh incentive for somebody to borrow more to increase capacity. Let's say you own a chain of 50 hamburger restaurants. You've got a spreadsheet in your back pocket for store number 51. But unfortunately, at the bottom, A173 is red. It's not going to work. And then all of a sudden, the Fed comes along, or the market, whatever it is, lowers the interest rate, and you plug in the new interest rate, and that red turns to black. You now have a business case to build your store. So every time it ticks down, that is a decrease in the expense side of everyone's business case, whether it's more hamburger stores, whether it's more, companies that manufacture grilling equipment for hamburger stores, plate glass window manufacturers, everybody, their business case to increase capacity clicks into black ink as soon as the rate falls.
Assuming they got debt on the balance sheet.
Or they're willing to take the debt, or have capacity for debt. And so for 40 years, you have that going on. You have all this capacity that was incentivized, dare I say, subsidized by the falling rate. Now you turn around and want to hike rates. All of that capacity is suddenly rendered submarginal. So first of all, you're going to have a train wreck of an economy with defaults cascading, all over the place. That is going to be bitterly unpleasant. I don't think there's any political will for that. But leaving aside the political conclusion, there's no demand for that credit at higher rates.
Right.
And the thing I can point to for consumers to be able to put their finger on is the ads to buy new cars are still saying 0% for 72 months. Now, back when, during ZIRP, before 2022, that was a subsidy paid for by Ford Motor and GM and Toyota, and everybody was doing it. That was a subsidy because they have a real cost of capital that isn't exactly zero. In those days, it was 2.5% or something like that. And then they have administrative costs, and there's a certain percentage of people who just default on the loan, and it costs money to repossess cars. People smash up their windows when they're about to get repossessed, all this bad stuff. So there's a subsidy to that, even at 0%. And now that the rate is, they're paying probably 7 or 7.5 or something. So the cost of that subsidy has gone up massively, and they're still doing it. Why? Because the demand for cars would fall off a cliff if the car buyer had to pay the market rate of interest. And I think that's true everywhere in the business and corporate.
And they're doing it in the housing market too, Keith. With the new home sales, all of these builders came out and they incentivized people to buy by lowering the interest rate for them. But that's right. Not free.
Right.
The home builders are having to fork up what is effectively the 4% interest rate if the market is at 7%, and they're giving you that 30-year mortgage at 3%.
Right.
And then what does that do? Then that cuts into their margin. And at a certain point, there's no more margin left.
Right. So we're in a world of basically compressing margins. And that's not a world where they're going to bid up the interest rate.
Yeah, that's right.
I've been expecting, I said, look, they can hold the interest rates artificially high for a while. I can't make a timing prediction, but at the end, the interest rate's going to collapse with a vengeance back to 0 and probably beyond. Maybe we're seeing it now. I mean, the interest rate came down from 4.6 to 4.1 something yesterday. So maybe that's it. Maybe they, blip it back up. These things have a life of their own, and they last longer than you think. But at the end of the day, I expect falling interest rates. The 40-year trend continues.
Yeah, and I want to unpack that a little bit there, because you said artificially high interest rates, and I think that's going to shake up a lot of people because they're accustomed to hearing artificially low interest rates. But I'm assuming you're saying that because of the price action we're seeing, not just along the curve, but I would point to the 2-year, like we said earlier, how the 2-year almost always precedes what the Fed is going to do. And the 2-year right now, let's say, is 3.95, and you got Fed funds at 4.33. So that 2-year is sending a message to Jerome Powell that, in fact, whether we like it or not, based on market conditions, that Fed funds rate is too high. Is that why you're saying it's artificially high?
Yeah, I'm saying more than that, but yes. So in my full theory of interest and prices, which is probably beyond the scope of today's conversation, you should have a positive spread between time preference and interest. In other words, in a free market, nobody's lending below their time preference.
Mm-hmm.
And you should have a positive spread between time preference and marginal, return on capital. Right. So you can't borrow at 10 to make 8.
Right.
That's an iron law. And no one is going to lend if their time preference is 3. No one's lending at 2. So you should have that like that. Now, that's in the gold standard where people have a free market and they can withdraw the gold coin if they don't like the interest rate. What happens when the government imposes a fiat paper standard is now you can push the interest rate down. And of course, this concept of marginal time preference is not a mainstream concept. It's an Austrian concept. So they're not aware of this. So they just push the interest rate down. And that's where my theory begins. It says, okay, what happens if you push interest below marginal time preference? Well, you get this positive feedback loop with ratchet effect. And that was when the Fed was created in 1913. You get a rising interest rate for a bit, but then things happen and then it reverses. Again, you had the rising interest rate in 1947 and 1981, and then it reversed with a vengeance in 1981. And we're in that posting now, but there's a ratchet effect. Every time it falls, you get more marginal capacity being added, which pushes down on consumer prices.
Yeah, because yeah. And then the downward pressure on consumer prices, even if it's disinflationary, is sending a message along to the curve where growth and inflation expectations are lower, and therefore the interest rates go down even further.
Yeah, so it's what you want. Like if you look at the physical world, almost everything is dominated by negative feedback systems. Anything that was positive feedback, like I don't know, nuclear fission bomb, goes catastrophic very quickly. And nature is full of negative feedbacks. The more you get of this, the other things come in and kind of tamp it down and dampen it. And this is a positive feedback loop, and very dangerous. So a falling interest rate for 40 years is really bad. I'm not in favor of this. I'm just saying, this is what. If we want to be oncologists, we're studying cancer. It doesn't mean we like cancer.
Right.
This is the mechanism. It's not any of these other mechanisms, but this is how it works. And so, yeah, I expect the interest rate to fall. So my comment about artificial is the Fed is fighting this, dynamic, which is much bigger than the Fed. And eventually they're going to lose. And the way they do it, they invert the spread, obviously, which they've done. And then that inverted spread starts to put pressure on the banks in funny ways. All kinds of other assets. Again, if you borrowed money at 2 to build an asset that returns 4, and suddenly the interest rate's 5, at some point your asset has to be liquidated.
Right.
You can't sustain that forever. And these things take a long time. There are lags on this, a variable. But at the end of the day, you're going to get, reversal of all the wonderful trend of the 1980s and 1990s if you try to push interest rates up. And I don't think that, there's any appetite for it. Plus, I think it would destroy the monetary system. Look at Silicon Valley Bank, right? So Silicon Valley Bank was taking in deposits during, the height of COVID when the interest rates were obviously on deposits were 0. And they bought a lot of 10-year treasuries that were yielding 0.6 something percent interest on the 10-year at the time. And, Powell hikes rates, the 10-year goes up massively. And, there was no question as to the quality of the asset. No one was questioning whether the asset would default. The problem is there's a duration mismatch between the demand deposits were being redeemed, right, at an exponential rate in winter of 2023.
No, it was March of, was it 2023? I know it was March, yeah.
Yeah. So it was the year after Powell started hiking rates. They had an exponential, bank run essentially. And, they had to dump their treasury bonds. But by that point, the 10-year treasury was down 20-something%. Mm-hmm. And so destroyed the bank. This was without any question as to the quality of the asset. The asset wasn't impaired, just the market price was down. Now imagine you're the bank and you hold all these bonds of people that built factories and hamburger restaurants and whatnot. And the quality of it, the ability to service the debt is in question. I mean, the train wreck would be...
It's not just interest rate risk, it's credit risk as well.
Right. It would make 2008 look like a dress rehearsal. So how much appetite do they have for that? Well, your guess is as good as mine, but I don't think they do.
But and I just want to be clear, in that scenario, interest rates go down, they don't go up, because it's
interest rates will go down. That's right. That's right.
Yeah, because you're going to have that flight to safety, whether we like it or not. I don't like it because it allows the government to spend even more, which I think distorts the economy, which in my view is the real problem. But we're not here to say that we like it or we don't like it. We're just explaining how the system works, so you can include that into your analysis. And another thing that I'd like to point out about Silicon Valley banks, a lot of people peg that on the Fed, maybe because they're raising the front end of the curve, but they don't have much control over the long end, at least not as much as growth and inflation. So let's just assume for a moment that the Fed would not have raised rates. Well, I guarantee you the 10-year Treasury would have gone to a level, maybe even higher, because inflation expectations would have been higher. Keith, you know what I mean? We forget that we had 9.1% CPI, and the 10-year Treasury yield got up to, during that time, I think it was around 4.5%. So that's when the Fed is increasing rates. So let's just assume for a moment that the Fed pegged it at zero, the front end of the curve. I would argue that growth and inflation expectations could have been even higher, and therefore that 10-year Treasury that Silicon Valley Bank had on their balance sheet would not have been yielding 4.5. It would have been yielding 6.5 with an inverse relationship, so the price would have been even lower.
Yeah, I'm not sure I agree with that, because I think there's no corporate demand for credit. What would be driving the rates up like that? But either way, right? It's once that bond price is falling, you're going to get a cascade of defaults.
Yeah.
And eventually, that turns into what people focus as recession. GDP declines 2 quarters successively, but it's the credit is really what's driving the whole thing.
Yeah, that is interesting too. You bring up the point that these bond investors have alternatives. It's not just the Treasury market; it's also the corporate bond market. And if they've got that as an alternative, how does that price go? How does that coincide with the Treasury at the long end of the curve? Because that would put downward pressure on the 10-year Treasury, because you've got capital that has that option. That gets a little complex, like a white.
There should be a positive spread between the corporate bond and the Treasury bond of the same maturity.
Yeah, well, there should be. I mean, right now,
because of weird inversions and
Yeah, right now the corporate spreads are extremely low. I think going back to the GFC, but I won't harp on that too much but that is very interesting. I want to think that through. Your standpoint there. I want to think that through after the interview. But now let's. So bottom line here is, you think interest rates are going down throughout the rest of 2025. How low do you think they'll go? And then, and I already know the answer to this, but I'd like your take. Is a lot of people assume that if interest rates are lower, well, that means the economy is going to boom. And in my view, they put the cart before the horse there, because you have to ask yourself, why are interest rates low?
That's exactly it.
So anyway, I'll let you expand on that.
I've seen the statistic bandied about that, when the Fed lowers interest rates, recession follows. And this reminds me of, if you're familiar with gel-man amnesia, it's this concept that, people read, some stupid article on page 1 of the newspaper, and they just say, that's so retarded because I know that field. They turn to page 2 and they return to credulity, where they believe everything the paper is saying.
Oh, right.
In terms of gel-man amnesia. Anyway, if you Google that, there's a quote by Michael Crichton, where he talks about, this idea of the paper is full of these stupid stories. And he said he calls them wet streets cause rain. Stories where they get the cause and effect reversed or something like that. The reason why the Fed is cutting is because they're terrified of this cascade that's already begun, and they can see it because they're talking to all the, the regional central banks, and the regional central banks are talking to all the major commercial banks in their region, and the commercial banks are talking to all the major borrowers, and they can see, the cascade of defaults coming long before they make the headline news. So they cut the rates desperately in an attempt to stave off, whatever's coming, but by that point, it's already baked in the cake. Once you go, kind of 60 to 90 days delinquent, the odds of you recovering, now the Fed's going to lower interest rates, it's too late, man. You're in a world of trouble. You're in the hole. You're trying to dig yourself out, but you're digging deeper. They lower rates. It's not going to be, fast enough to save you. And so, whether the timing is this year, I think it's increasingly likely this year, tariffs are only going to make it more difficult for business. So if businesses are already struggling, now you put one more burden on them. Some camel's back somewhere is going to snap, and then their workers are unemployed. They miss their truck payments and whatever other payments, and then that puts other pressure on, and then you get this cascade, this domino effect. Is that this year? Increasingly, I think that's likely, but on the other hand, and I've written a lot about this. I think today's Fed looks at the 2007, 2008 Fed as having been, neglectful, negligent, and asleep at the switch.
Right.
Today's Fed is hyper proactive. So, if they're like a squid, can they tamp and damp every little thing just as it's happening? Maybe they can. Maybe they can get ahead of it and they can kick that can down, the road one more quarter mile. That's the thing that I certainly can't predict.
Yeah. I think people get too myopic when it comes to interest rates, as if that's the only problem. Whereas if interest rates are going lower, it's a reflection of what's happening in the economy. So that's most likely affecting revenues. So you can't just look at it at the expense side of the P&L in terms of the debt. You've got to look at the income side. And as an example, so you've got, let's just say, a homeowner out there, and let's say they have adjustable rate mortgage, and the mortgage rate goes up, they get it at 3, it goes up to 5. So now all of a sudden they have this pressure on their paycheck every single month. It becomes harder and harder and harder for them to make that mortgage. And then you say, well, all the Fed has to do is drop rates down to 3%, and then they're good to go. But in that environment, there's a high probability that they lose their job. So if the Fed go ahead.
And they're buying less pizza and less, drinks at the local bar, less trips to the movie theater. They postpone buying a new car. All these things happen, and all those other companies find pressure on their revenues, even if they have fixed rate debt.
Yeah.
And, so it cascades through.
I've always tried to figure out what moves the gold price. And I've even done whiteboard videos on this, where I'll go back and, all the usual suspects. It's the inverse of the dollar, it's inflation, it's deficits, it's the debt, it's war. And I go back to like the 1970s, and I try to look at a chart of the nominal gold price and everything, or M2 money supply. I can't find anything that correlates to the price of gold over the long term. So this is your business. I'm sure you've studied it quite extensively. What the hell actually moves the gold price? I don't know. I can't figure it out. I know over 100 years, it'll buy the same amount of stuff, but that doesn't help you out over the next year or 3 to 5 years.
So we every year we publish something called our Gold Market Outlook Report. And so it's about to come out in the next couple of weeks. But in years past, we've done graphs of the gold price and overlaid against, everything you mentioned, various measures, the money supply, various interest rates, nominal interest rates, real interest rates, CPI inflation. And over short periods of time, you can find, cherry pick windows where the correlation is, bang on. But over the long haul, not so much. This is where I get very controversial, because I am not a advocate of the quantity theory of money. I don't necessarily think that if you double the quantity of dollars, first of all, I don't concede that's money anyway, but I don't agree that if you double its quantity, necessarily prices will double, let alone the gold price. What I do is I say, first of all, invert, we should be looking at the price of the dollar measured in gold rather than the price of gold measured in dollars, because gold is the money and the dollar is, imagine you're standing on the deck of a ship, and the ship is slowly sinking, and there also happens to be a big storm, and the waves are going up and down. And you're looking at the lighthouse on the shore and saying, why is the lighthouse going up and down and mostly up? It's your vantage point. And
right.
We're in this incredible dollar bubble that colors that vantage point. But if you look at it the other way, say, okay, it's the dollar going down. What makes, the dollar's a credit instrument. What makes the credit instrument go down? Not necessarily its quantity, but its quality. And every time there's a little crisis or some event, the Treasury or the fiscal authorities or the Fed, respond in ways that make the quality worse. That is, bring closer the day when the whole thing is going to collapse and they're going to fail. They're going to default. And every time that happens, so you look at the crisis of 2001, which looks very pedestrian compared to the crisis of 2008. And that looks, I think, small compared to the next one that's coming. Each time you have that crisis, first of all, you get new people coming to the gold market. I didn't own any gold before 2008. I bought my first bit of gold in fall of 2008, and started to study it and did a lot more after that. A lot of people came to gold in 2008. I'm certainly not the only one. A lot of people came to gold in COVID. You just look at the insane response. Government's already running $1 trillion deficit, and then we passed the CARES Act. I love the names of these things. Orwell, right, looking down, saying this wasn't supposed to be a recipe book here. That they added 2.8 trillion more to what was already $1 trillion deficit. And every time people see that, they think, now I get why I should own some gold, because gold isn't exposed to that, right? And now you look at the response to Russia. I'm not a huge fan of saying that, this teaches the world you can't trust the dollar, you can't trust the US. But the response was to lock them out of the dollar, seize their assets. That made some people say, I want to maybe own a bit more gold.
Right.
Now you look at the trade wars that are going, and are we enemies with Canada now and Panama and Greenland, which means Denmark? Like, what's going on? Nobody knows. Uncertainty makes people want to repudiate. They want to get rid of that credit and they want to own something tangible. And so that it's ultimately the change in. I hate to say mass psychology, because it's more than just animal spirits. It's more than just emotions, but the change in the belief or the sentiment. When that hits large numbers of people, then obviously they want to move out of paper and into gold. And so you get a big rise in the gold price. Obviously over 2024, that happened in spades. We went from 2,100 to 2,900 or something, which is a big move.
Yeah, it's funny you say that, because that was the exact conclusion I came to in the whiteboard videos where I was trying to ask that question. It's really about uncertainty. That's the only thing that I can peg it on, is the more uncertainty you have, the more people want to go into an asset that has no counterparty risk.
That's it.
Yeah. What do you think about the gold silver ratio? Is there anything to that, or is that overblown?
I mean, the gold silver ratio is incredibly high by historical, standards. There's always that debate as to whether or not we still need silver as money. It's obviously in modern world, it's not for small change. I mean, it's not like we buy milk and bread and eggs and cheese with silver. We buy cars with gold. I mean, no one's spending either of them right now. But if you're setting aside 10% of your, let's say you're skilled blue collar worker, and you set aside 10% of your weekly wages to put into precious metals. If that's gold, you're talking a very, very small amount, and you'd have to get it in one of those 30 cards with a little window. You wouldn't put it in your pocket because you could lose it in the lint. But in silver, you get a small handful of metal. But now you have, first of all, digital accounts that fractionalize bars of gold, so that's not really an issue anymore. You have things like the gold back, and Monetary Metals leases gold to Valorum, which is the company that manufactures that. And that gets you down to 1/1000th of an ounce, roughly $3 worth of gold in this little currency unit thing. So is there a need for silver? And the more that the market doesn't think there's a need for silver, the silver will be demonetized, then you see a very high gold-silver ratio. And the more the market expects silver to return its money, that'll flip. I'll sort of telecast
the premium on silver is for temporarily or maybe permanently, who knows, is kind of vanishing. So it's trading just specifically on industrial demand.
Or more so than, right, the monetary premium is much lower than gold. So I'll telecast, what I'm talking about in the Gold Outlook report, that, if gold could be, let's say 3,700 end of the year, could be more than that, but let's just call it that, then that would put silver at 36 or 37. We just don't see, if you look at the data and the graphs, it just doesn't have the way it behaves when the price moves up. the basis moves up much more in silver than in gold. And when then the price comes down, the basis doesn't come down as much. It's not behaving the same way as gold. And the demand just isn't as robust. And there's a million and one reasons. Silver tends to be the money of the people, the working people. I think the working people are under much greater stress, much greater pressure. Gold's a capital asset and it trades against other capital assets. So as long as capital assets are doing well, which they have, then, or even if they're not doing well, the capital owning class is always looking for whatever asset's going to do well. They tend to favor gold much more than silver. And you talk to, out of 20 family offices, there's maybe one thinking about silver and 19 are gold only.
Yeah, right. So is it safe to say that throughout 2025, you'd be a little more bullish on gold than silver?
Yeah, absolutely.
Yeah. So tell me about your entrepreneurial journey, or your last entrepreneurial journey with Monetary Metals. Now, I'll go ahead and make the announcement that you were nice enough to sponsor the channel for a couple months. So I'm really looking forward to that. And I've turned down pretty much everyone that's come to me and offered sponsorship because it wasn't really a good fit. But then when I heard about what you guys do, first and foremost, I got excited about it for myself. I'm like, okay, this is something that actually I want to use.
Cool.
So anyway, so that's why I'm like, yeah, if you guys want to sponsor some videos, that would be awesome. Because if I want to use it, I'm sure there's a lot of people in the audience that want to use it as well. But how did you come up with the concept, and what do you guys actually do?
So the concept is very simple. We pay interest on gold in gold. Mm-hmm. On gold, paid in gold is our Circle R registered trademark. And so, the concept is as old as time. I mean, deposit your metal, earn interest on it, try to minimize the risk as much as possible. Of course, there's no such thing as a return without risk. Anybody promising that, run, because that's not legitimate. Right. But we have insurance. We have all kinds of things to minimize the risk. We have a good track record. We've been doing this 9 years now, 64, 65 leases at this point that we've done. And then a couple of bonds as well. So the concept, two different programs that both achieve the same value proposition, which is the interest on gold. One is leasing. Leasing is not a securities offering. It's open to the general retail public, minimum account size of 10 ounces, but $29,000 roughly nowadays. Leasing is for companies that have, people have heard that term, central bank leasing gold, bullion banks leasing gold. That's not what we're doing. We are working with businesses that have physical metal as inventory or work in progress. So think of a jewelry store. You walk in, there's always X amount of ounces underneath the glass in display cabinets. Refiner, recyclers, mints, jewelry manufacturers, high-tech coatings companies like Valorum that are sputtering gold onto plastic film. There's about a dozen different verticals where they need a physical amount of gold at all times in the business. And every day they're selling some finished product, but every day they're buying more raw gold. And there's always a certain amount. I think of like an oil pipeline. The amount of oil contained in the pipe is math. It's the length of the pipe times the diameter times pi. I'm sorry, no, times the radius squared times pi. It's been a long time since I've taken geometry. And it doesn't matter how fast it's flowing. That is the amount of oil that's contained in the pipe. I don't know whether pipeline companies have to finance that oil, how valuable that is. I've never thought about that. But in any gold business, that gold has to be financed because gold is almost $3,000 an ounce. And you need a fair bit of gold to run a business, so you got to finance that. So we lease them the metal, which means that, you, the owner of the gold, once the gold is in lease, you own some of those rings and necklaces and earrings and whatever.
Because that's the collateral.
Not collateral, you actually own it. It's your property that you're renting to them. It's no different than, you go into the Verizon store and, get one of these things, and they rent it to you. It's a rental agreement. It's their phone. At the end, you give it back to them. Now, the difference is, of course, that becomes obsolete, becomes scratched and dinged up and worn. The battery life isn't the same after 2 or 3 years of charging and discharging. So it degrades, whereas gold, doesn't degrade. Gold is always gold.
Right.
As long as you have the right number of atoms of, element number 79, it's all good, but it's just rental. So what makes a lease, it's not It doesn't become monetary metal. It's not a credit to monetary metals. It's not our asset. If we were to declare bankruptcy, your gold is bankruptcy remote to us. It does not become the asset of the lessee, the jewelry store, let's say. If they were to declare bankruptcy, it's just a matter of repossessing rented property. It's not a credit. You're fighting, bankruptcy court. The other property of a lease, the metal is physically there. We could go on premises, take all the jewelry, put it on a scale, and weigh it, and it would be greater than the fine amount of fine gold would weigh greater than the lease amount.
Yeah, right.
And so if jewelry is 18 karat, we don't count the other 6 carats. That doesn't count. Only the 18 of gold. And it's the lowest risk thing that we can think of what to do with gold to generate a return on it. And the interest rate currently is 4%.
Yeah, and that's how you are paying the clients in gold, because you are lending the gold to someone who also has gold as inventory. So basically the whole transaction is in gold.
That's right.
There's no real dollars in the transaction.
Right. The jewelry store doesn't want the price exposure of the gold versus the dollar.
Yeah,
Metals doesn't want to take any price risk either. So we're leasing gold from you, putting the gold with the jeweler. The jeweler has someone else's gold. So price risk is not their problem.
Yeah.
And the investor is taking the price risk, but the investor, by buying gold, is taking the price risk anyway. The difference is now they're getting 4% versus they're paying 0.75% for storage.
Mm-hmm.
Right. So everyone's got their gold somewhere. And if you have it at home, you're taking the risk of home invasion or theft or flood or fire. If you have it in professional, vault, most people are paying an average about 75 basis points. So now you're getting paid. That's the difference. But you're taking the price risk anyway. We're shifting the price risk from the jeweler to the investor who owns the gold. We're obviously bringing the capital here. It's a win-win transaction. And what we're doing is we're using gold as a vehicle for finance, which is something that has not been done since 1933 when Roosevelt, terminated the gold standard.
Yeah. So to make it super simple for people, I take 100 ounces of gold. I put on deposit, let's just say on your platform with your business. And then you take the 100 ounces, you lend it to a jeweler or someone who uses gold as an input within their business, and also receives gold as well, or buys gold. So they've got that inventory. And then at the end of the year, they give you, let's just say 104 ounces of gold. And then that's what goes back into the person's account. And that's how you're paying the interest rate in gold.
Right. So the jeweler would obviously give us a bit more. That's how we make our money, is there's a spread interest rate, but they give us a bit more and we pay 4% to the owner of the gold. So you get back 104 ounces at the end of the year. So if you like owning 100 ounces of gold, you should like owning 104 ounces of gold even more.
Yeah. And then with the only difference between the lease and the bond is the bond is exclusively there for, or is only available to accredited investors.
Accredited investors, that is a securities offering under Reg D, United States, Reg S for offshore investors. That is a credit. So the risk is different and obviously higher. Right. And that's for businesses that don't have gold inventory, but have gold income. So they can amortize the debt.
It's like a gold mine.
But let's say gold mine, right? They're literally pulling gold out of the ground.
Mm-hmm.
Now the risks are higher. The interest rates are much higher. So the interest rates on that will be at lowest, like say high single digits and well into the teens, depending on the mine. But these are publicly traded mining companies, and they're investors that are happy to own the equity. We're taking a lot less risk than the equity because we're secured creditors. So if the mine declares bankruptcy and fails, the debt has to be paid first, and so all the assets will be liquidated for the benefit of the creditors.
Right. And just for the viewers who are considering this, it's basically you set up an account, you've got your dashboard, and then within the dashboard, you can choose which deal you want to participate in. So then you can see the details, and it's not like you're forced in one direction or the other. You have the choice as the owner as to who you want to lend to, if you want to do a lease, if you want to do a bond, and to what degree and what percentage of the gold that you have or silver that you have in storage with your company Monetary Metals.
Right. We take no discretion over client metal.
Yeah.
Very, very important. You see all the the deals we present, and you choose which ones you want to participate in. you're in control.
Yeah, I'm excited. I mean, I set up an account, as you know. I've got some gold in there now, so I'm probably going to do the lease thing initially just to get my feet wet. But then once I get a little confidence, maybe I'll start looking at some balance sheets to try to get a little bit higher interest rate. But I'll share what I'm doing with the audience. So, what's the website, Keith?
Monetary-metals.com.
Okay, great. And I'll put a link in the description below. Appreciate the time, my friend. I know you're setting up a brand new office in Dubai, so I'm sure you're extremely busy. And fun conversation. We got to do it again soon.
All right. Let me know.